Now let's continue with our discussion from where we left last time. This is advanced financial reporting, and we started chapter one last week or towards the end of last week. We have already completed International Financial Reporting Standard number 16 or IAS 17. That is leasing, where we comprehensively covered issues to do with operating lease as well as finance lease. Just as a recap, before we take the next chapter, is that we said that there is a slight difference between IFRS 16 as compared or contrasted with IAS 17. That is something that we did. So we did some comprehensive questions relating to IFRS 16 and also a lot of discussions in details concerning International Accounting Standard number 17. Just as a reminder, we told you, or I told you that IAS 16 has already been superseded by IFRS 16 from 1st January 2019. Now we move away from there and we move to IAS 16, and that is accounting for taxes or deferred taxes to be specific. So IAS 16 is deferred taxes, and that is the next topic that we want to move to. Now, important things to remind you here with respect to deferred taxes or taxes is that you should understand the concept of taxation, because at this level you should be very familiar with taxation of businesses. Now, usually the accountants do prepare the income statement to arrive at the accounting profit. In this accounting profit, which is usually prepared by accountants, we usually deduct all expenses and we include all incomes. However, for the purpose of taxation, we understand that there are certain expenses which are allowable and others which are disallowable. And for that case, if the accountant has deducted all expenses, then for the purpose of taxation, we should add back some expenses which are classified as disallowable. With the incomes, there are certain incomes which are taxable and other incomes which are non-taxable. For the purpose of accounting, we usually include all incomes. However, from the perspective of the tax commissioner, then there are certain incomes which are allowable for the purpose of taxation. Or in other words, there are certain incomes which are non-taxable, thus we should not tax them. So you can see as a result of these two situations or environments which have been created here, that we have accounting profit and taxable profit. Therefore, our profits will differ for the purpose of taxation. And for that reason, that is why the IAS 12 came into effect. That is now, historically, if you look at the history and development of IAS 12, a lot has been happening with this particular international accounting standard from the year 1979, when it was introduced within the corridors of accounting standards. Well, again, something else that we should have in mind is that mostly the accounting matters are dealt with in line with the accounting standards. But tax issues, when it comes to tax matters are governed by the legislations of the specific country in question. For example, in Kenya, the tax issues are not governed by the accounting standards. The tax issues are governed by the Income Tax Act. So whatever decision that the accountants make when preparing and presenting accounting information, that is purely in line with the accounting standards or the International Financial Reporting Standards, the International Accounting Standards, the generally acceptable accounting principles, the GAAPs. However, if you look at from the other side of taxation, then taxation of business institutions and individuals are governed by certain laws and legislations as provided for by certain acts. For example, in Kenya, the Income Tax Act. So this is what this chapter is all about. That is IAS 12, income taxes. Now, as we proceed, I think I should remind you that there are certain key terms that we should understand here. That is things like what is current tax and what is deferred tax, what is tax base, and things like carrying amount or net book value, things like temporary differences, things like permanent differences, and such terms usually. So we should understand clearly the meaning of some of these terms. So we will first discuss a little bit of theories concerning income tax, IAS 16, and then I will take an example, a worked out example from past papers, advanced financial reporting, as it appears just on the board. So this question is advanced financial reporting, April 2023, question 3B. So if you have the past papers with you, I think you should have it very close to you. Don't put it very far from you. You can just download the paper from the KASNEB app, and then you can compare the kind of solution that we are going to give by the end of this discussion with what it appears on that particular paper. But before that, I will discuss a few terms here as used in that particular IAS, that is IAS 12. A little bit of some theories, some terms used, what are the meaning of certain terms used in IAS 12, and then after that, I will show you a question with a solution. Now, before I continue with my discussion, I wish to remind you that we started the advanced financial reporting classes last week, and we have that as far as chapter 1 is concerned. As I told you, chapter 1, advanced financial reporting, is accounting for assets and liabilities, whereby you are supposed to cover leases, including sale and leaseback, and dealers and leased assets. So we have already covered leases so far. So if you have not been part of us, you can just get those discussions in our YouTube channel, the leases. We have comprehensively covered leases, and we will continue uploading some of these classes as time goes on, and also for the purpose of your vision. So we have covered leases, that is IFRS 16. Now we are moving to deferred tax with group aspects. So deferred taxes, and also we look at deferred taxes also with group aspect. Now, after we have done deferred taxes, the next areas that will be covered in chapter 1 will be employee benefits, share-based payments, financial assets and financial liabilities, fair value measurement, and impairment of assets. Those are the areas which will be covered in chapter 1 before we move to chapter 2. So that is just as a reminder what you are supposed to understand completely, comprehensively, perfectly. Be very keen as far as chapter 1 is concerned because time may not be on our side. So we have covered leases. Now we are moving to deferred taxes. So just allow me to go at the back side of, I'll just mention a few things from the back side as you look at what is on the board. So I just want you to, I want to give you, to create a room here so that you can see what is on the board. I've told you this is Advanced Financial Reporting, April 2023, question 3B. So I will discuss the theory part of IAS 12, and then I will attempt a practical question for you on the board, and then we will take one more extra question, and then that will be the end of IAS 12, income taxes. So just try to see what is appearing on the board. As I mentioned, some key terms used in IAS 12. So I think you can see what is on the board. Now, so I can mention a few things from this side. And what I can say from this side is that IS 12 relates to accounting presentation of current tax as well as deferred tax. As well as deferred tax. Current tax refers to tax payable or recoverable in respect of the current profit or loss. Deferred tax refers to a provision made in the current period in respect to in respect of the expected future tax payable or recoverable. Deferred tax is the corporation tax that is likely to be incurred on the activities of a company during a particular period, but because of differences between the way activities are included in the accounting profit and taxable income will be paid in another period. So accounting for deferred taxes arises when a transaction is recognized for accounting purposes in the current period, but not recognized for tax purposes until later period. The accounting profit will differ from the taxable profit due to the allowable and disallowable expenses, as well as the presence of non-taxable and exempt incomes. The differences can be broadly classified into two. That is permanent differences and temporary or timing differences. Now for the purpose of the exam, these two terms are very important. That is permanent differences and temporary or timing differences. Permanent differences are the differences between the taxable and accounting profits that originate in one period but do not reverse in the subsequent periods. But temporary or timing differences are the differences that originate in one period but reverse in another, thus bringing about deferred tax. So those are important terms that I've mentioned there. And again, timing differences can also be defined as items reported in the accounts in periods different from those in which they are reflected in tax computations. These differences originate in one period but reverse in one or more subsequent periods. These are timing differences. That's the meaning of a timing difference. Then temporary differences include differences between the fair values and the tax values of assets and liabilities acquired and the effect of revaluing assets and liabilities acquired and the effect of revaluing assets for accounting purposes. Another term that you can define is carrying amount. So carrying amount is the same as net book value. And a carrying amount or net book value is an amount attributable to an asset or liability in the statement of the financial position. That's carrying amount or net book value. The other term is tax base. A tax base is an amount attributable to an asset or liability for tax purposes. It is the tax written down value. So in other words, tax base is the same as the written down value. When the carrying amount of an asset is higher than the tax base, the amount of the taxable economic benefit will exceed the amount that will be allowed for deduction for tax purposes. This difference is taxable temporary difference, and the obligation to the resulting income taxed in the future period is a deferred tax liability. Some temporary differences arise when income or expenses are included in one accounting period but included in the taxable profit in a different period. Such differences are referred to as timing differences. So understand the meaning of these terms. They are very important. As far as IAS 12 is concerned, you should be able to understand what are timing differences, what are temporary differences, what is a carrying amount, and what is a tax base. These are very important terms that you should understand as far as this discussion is concerned. Now, deferred tax usually occurs due to temporary or timing differences. So, what brings about deferred tax? Because that is a major area of discussion as far as IAS 12 is concerned. Deferred tax occurs due to temporary or timing differences. Taxable timing differences bring about deferred tax expense, while deductible timing difference brings about deferred tax income. On the other hand, taxable temporary difference brings about deferred tax liability, while deductible temporary differences brings about deferred tax asset. So these are the major items that I wanted to mention to you before we illustrate or we explain what is appearing on the board there. Now, as you can see from the board, that table up there is explaining something very important about taxable temporary differences. You can see the first line there. Taxable temporary differences. Taxable temporary differences. I think you can see it there. What I'm trying to illustrate is this point here. Now here we are saying taxable temporary difference occurs where the carrying amount, which is also known as the net book value. So when I talk of carrying amount, I mean the net book value. If your carrying amount is more than the tax base or the written down value, the other name for tax base is the written down value. If you take the carrying amount, these carrying amounts, remember, they are the figures appearing in your statement of financial position as a business. There are two things here. The amounts appearing in the books of accounts of the business entity, and then we have the tax base now. The amounts that the Commissioner for Domestic Taxes or the National Revenue Authority, that is, for example, if it is in Kenya, the Kenya Revenue Authority, their figure, what is their figure? That they want to associate with your items in the statement of financial position. So the government has their figures, and you as a business entity, you have your figures. As I have mentioned earlier, when presenting financial information, the accountants or the auditors should be guided by the accounting standards. So we have observed our accounting standards as a company or as a business entity, and we have our net book values here as a company. As far as the International Financial Reporting Standards or IAS or GAAPs are concerned. But the government, after following particular laws and legislations, they have their own figures relating to the same items that you have in the financial statements. So most of the times, the carrying amount in the financial statements of an entity may be different from that provided for by the government. In that case, so customarily or traditionally, if the carrying amount is equal to the tax base, then obviously there is no difference. There is no timing difference. Timing difference occurs in those situations where the carrying amount is different from the tax base. So back again here, what does it mean when we say, for example, taxable temporal differences occurs where the carrying amount is greater than the tax base? We are saying that situation there is a deferred tax liability. Why is it a liability? And why is it not an asset? That's the question. Why are we saying that if the carrying amount is more than or is greater than the tax base, then there is a deferred tax liability? What does it mean? So if, for example, let me assume a situation where, let me illustrate what we mean here. Why is it a deferred tax liability? And we know a liability means we, as a business entity, we have an obligation to pay in the future. So if I assume that I have PE, and my carrying amount, I have a PPE in my books of accounts, my carrying amount is 100. But the tax base by the government, I want a situation where the carrying amount is greater than. If my tax base is 80, the tax base by the government is 80. And in my books of accounts, my property, plant, and equipment is at 100. So there's a difference there. What does it mean? We as a business entity, we could not agree with the taxman or the Commissioner for Domestic Taxes about our PPE. So we used the accounting standards to arrive at the net book value for our PPE, and we arrived at 100. But the taxman or the government, they came and they told us that the tax base should be 80 concerning the same PPE. So there's a difference there. So why are we saying that this is a liability? In that situation, if the carrying amount in the books of accounts is more than the tax base, why is it a liability? It is a liability because the government is telling us it is 80, but we are saying that it is 100. So it means in the future, because the difference is 20, the difference is 20. The government said 20, and then we say it is 100. What does it mean? Why is it a liability? We are supposed to pay this 20 in the future to make it 100, to make the same, because we disagreed. The government agreed at a lower figure, we agreed at a higher figure. So we should, the government may come and tell us, we said 80, you said 100, so pay us the difference, the 20. So that becomes a deferred tax liability. That is simply what we mean when we say that taxable temporary difference occurs in those situations where the carrying amount, remember this carrying amount or the net book value, they are the figures as provided for in the books of the business entity. But this tax basis or the written down value, these ones have been provided for by the government after observing or through the observation, the guidance of the Income Tax Act or the tax regulations. So that's the meaning of that. That is what we mean by that. That temporary taxable temporary differences occurs in those situations where the carrying amount is greater than the tax base, and that gives rise to deferred tax liability. The opposite of taxable temporary differences is deductible temporary difference. Is the opposite. It occurs in those situations where the carrying amount is less than the written the carrying amount is less than the tax base or the written down value. In that situation, it becomes a deferred tax asset. So why is it a deferred tax asset in that case? Now let me explain to you briefly why deductible temporary differences will give rise to deferred tax asset. Now I assume that using the same illustration, if your PPE, the carrying amount is 80 in this case. Now forget about this one. If your PPE in the books of accounts is 80, but the tax base is 100. Now, you have provided in your books of accounts that the carrying amount or the net book value is 80, but the government is telling you it should be 100. What does it mean? Why is it an asset? Now, the government has your money. As the difference, the extra 80 is with the government. So it means in the future, the government can refund this 20 back to you. The tax base is more than the carrying amount. Anything may happen and then you convince the government that the figure was overstated, so they have your money, they have your 20, so they will have to refund the figure. And that is the reason as why this one now is referred to as deferred tax liability, deferred tax asset. I beg your pardon. Deferred tax asset. Situations where the carrying amount is less than the tax base, that gives rise to deferred tax asset. The examiner may ask you to differentiate between taxable temporary difference from deductible temporary difference. You can just answer that question by saying, like for example, I think the question that you take tomorrow morning is a question which is asking about difference between taxable temporary difference and deductible temporary difference. So what's the difference? It's simply here differences which arise as a result of the carrying amount being greater than So taxable temporary difference occurs in those situations where carrying amount is greater than the tax base, giving rise to deferred tax liability. And deductible temporary difference occurs where the carrying amount is less than the tax base, giving rise to deferred tax asset. Again, if anybody is asking you to differentiate between deferred tax liability and deferred tax asset, you can just get the meaning out of what we have discussed there. Now, this lesson, because my focus is about how you prepare schedule of temporary differences, and these ones you usually get them from statement of financial position. For today, I will not take a question to do with taxable timing differences. I will take a question with taxable temporary differences. But I mentioned here taxable timing differences occurs where accounting profit is greater than taxable profit. That gives rise to an expense. Or in other words, what we are saying is that taxable timing differences occurs where depreciation is less than capital allowances. The opposite is known as deductible timing difference. Deductible timing difference occurs where accounting profit is less than taxable profit, and that gives rise to income. In other words, situations where depreciation is less than capital allowance, that gives rise to deductible timing difference. So you can use that table that we have there to explain the meaning of any of these. So basically, these two, you find them in the income statement. Taxable timing difference, you find them in the income statement. Deductible timing difference, you find them in the income statement. Because it is in the income statement where you get expenses and incomes. The other two, taxable temporary differences and deductible temporary differences, you get them in the statement of financial position because that is where you get liabilities and assets. So that is the meaning of what we have done for today. The meaning of taxable temporary differences and deductible temporary differences. Now, I want us now to look at a question from the past papers, and that is an advanced financial reporting, April 2023, question 3B. So, if you have the paper, you can just check what is the question in that particular paper, and then we can just look at the solution. You can just look at the question, meanwhile. Check the question, meanwhile. Check the question. If you have the past paper, I believe you have the past paper with you. I think I can project the paper. If you do not have it for any reason, you can check that question. I can project that question. I can have it there. You are told that is 3B. The following statement of financial position relates to ABC Limited, a public limited company. is that 1st March 2022, assets, you have PP 10,000, goodwill 6,000, other intangible assets 5,000, financial assets at cost 9,000, total that 1,000. Current assets, trade receivables 7,000, other receivables 4,600, cash and cash equivalents 6,700, total 18,300, total assets 48,300. Equity and liabilities, share capital 9,000, other reserves 4,500, retained earnings 91,30. Non-current assets, long-term borrowings 10,000, deferred tax liability that's 600, employee benefits 4,000, current tax liability that is 70, trade and other payables 5,000, total liabilities 25,670, total equity and liabilities 48,300. Now that is a statement of financial position. Statement of financial position of the company. Statement of financial position of the entity. I remind you something before I continue. I have said that deferred tax liability and deferred tax asset, or taxable temporary differences and deductible temporary differences, occurs in those situations where the carrying amount is different from the tax base or written down value. So that is statement of financial position that I have shown you there. It is the carrying amounts as presented by the business entity. So if you find that the figures that I have presented to you there in the statement of financial position are the same as the tax base as provided for by the government, then there is no temporary difference. If carrying amount is equals to the tax base, then there is no temporary difference. But if in any case you realize that the carrying amount is not equal to the tax base, then there is a temporary difference, which can either be deferred tax liability or deferred tax asset. So that is the one very important thing that you should know whenever you are dealing with IAS 16. Always identify what is the carrying amount, what are the net book values of assets and liabilities as presented for in the books of accounts of the business entity. Again, note here, your concern should only be with assets and liabilities, not equity. So don't mind about equity side. It's only assets and liabilities. So that's an important point that I have clarified to you, that the examiner will always provide you with the statement of financial position or the balance sheet, the information or the current or the carrying values, the carrying amounts or the net book values is provided for by the business entity. So the other thing is to identify what are the tax bases now as provided for by the government. So if the carrying amount is equal to the tax base, then there is no temporal difference. So let me project the other part now, which is in the additional information. What is in the additional information? And I believe you have the paper with you. You have the paper with you. So you can have it. You can have it. You can have it. I'll project it in a while. And we are told The following information is relevant to the above statement of financial position. The financial assets are classified as fair value through other comprehensive income as shown in the above statement of financial position at their cost on 1st April 2021, including transaction cost of shilling 0.5 million. The market value of the assets is shillings 10.5 million on 1st March 2022. Taxation is payable on the sale of the assets. Number 2, the stated interest rate for the long-term borrowing is 8%. The loan of shillings 10 million represents a convertible bond which has a liability component of shillings 9.6 million and an equity component of shillings 0.4 million. The bond was issued on that 1st March 2022. Number 3, the defined benefit plan and a rule change on 1st April 2021. MBC Limited estimates that of the past service cost of shillings 1 million, 40% relates to vested benefits and 60% relates to benefits that will vest over the next 5 years from that date. The past service costs have not been accounted for. The tax basis of the assets and liabilities are the same as their carrying amounts in the statement of financial position as at that 1st March 2022, except for the following. Now, very important thing to note there. I've told you that the examiner will give you statement of financial position as prepared by the accountants or the company. But we expect ordinarily or traditionally the carrying amounts to be equal to the tax base. So if the carrying amount is equal to the tax base, then there is no temporal difference. But in this case, point number 4 is very important because these are the tax bases now from the government side. So you'll be comparing the amounts that you have in the statement of financial position with the items you have in point number 4. Now, they are there, point number 4. The tax basis of the assets and liabilities are the same as their carrying amount in the statement of financial position, except 1, PPE, 2400. You can see PPE from the statement of financial position was 10,000. Okay, PPE 2400, trade receivables 7500, other receivables 5,000, employee benefits 5200. Other intangible assets are development costs which were allowed for tax purposes when the costs were incurred in 2021. Trade and other payables include an accrual for compensation to be paid to employees. This amount to shillings 1 million and is allowed for tax purposes when paid. Number 5, goodwill is not allowable for tax purposes in the jurisdiction of ABC Limited. Number 6, assumed taxation is payable at the rate of 30% required, applying the requirements of IS 12. Calculate the temporal differences after the necessary adjustments, 10 marks. Number 2, determine the deferred tax charge for the year ended that 1st March 2022, 2 months. So those are important points that you should note as far as this discussion is concerned. Now, before I take the explanation, and I advise that you have the past paper with you so that you may be checking what is that paper. So go through the paper, the question, go through the question. Now, before I take that question, you can also have these notes with you. You can have these notes with you. And because I've told you that with this, when determining taxable temporary differences or deductible temporary differences, I have told you, you will be concentrating on, that is what I said, our focus should be on items that you find in the statement of financial position. We are not interested with the items that you find where? In the income statement. That is our concern here, because we are looking at items that have been presented by the accountants guided by the accounting standards. That is International Financial Reporting Standards and IAS 12 as it appears here. If need be, accountants have prepared the statement of financial position or the auditors, but the government is giving different information pertaining to the same items. So, the business entity has presented the carrying amounts or the net book values, but the government has presented different figures in the statement of financial position. You know that. So I'm saying that because what I'd be interested with is taxable temporary differences and the deductible temporary differences. So for now, forget about the taxable timing difference and the deductible timing difference for the time being. Now, the most important thing as far as this question is concerned is knowing what are some of the guidelines concerning these assets and liabilities. For example, if you have cash, because cash is a current asset that you find in the statement of financial position, do we have situations where cash, as it appears in the statement of financial position, as a current asset, the figure may differ from what the government is giving you? The answer is obvious. It is not possible. So cash, the net book value for the cash as provided for by the company or the business entity must be the same as what the figure that the government is giving you. So in that case, it means that it is not possible for cash figure to give rise to a temporary difference. So it will always be zero. Other items like goodwill, obviously, there will be no difference between the net book value as provided for by the accountants in the business entity with the tax base from the government side. So I want to mention a few things here concerning what methods do we use to identify which items will be having these temporary differences for the time being. So as you look at that question, because I advise that you should have the past papers with you, and because my projection may not be very clear, and again you see after making that projection in the camera, I'm removing the camera for the paper from the camera so that you can look at this solution for the time being, as I mentioned a few items here and there. Now let me just mention two things here before I read important points. Now here, because we are required to show the deferred tax charge for that particular year, you are supposed to prepare schedule of temporary differences. Remember, temporary differences will be arising in those situations where the carrying amount or the net book value as provided by the business entity is not equal to the tax base by the government. Take, for example, property, plant, and equipment. The first item that you find in the statement of financial position as presented by the company, property, plant, and equipment was 10,000. But additional information number four, I think number four, they are telling you now that statement which said that assets and liabilities are the same except for the following. Except, so you can see property, plant, and equipment is not equal to 10,000. Is 2,400. So there is a difference there. So you take the carrying amount minus the tax base, and the difference is 7,600. So in this case, you can see that carrying amount, which is 10,000, is greater than 2,400. Carrying amount or net book value is greater than tax base. So what does it mean? This is what we say. We say that if carrying amount is greater than the tax base, then that gives rise to deferred tax liability. So there is a deferred tax liability of 7,600. Why is it a deferred tax liability? Because our net book value is 10,000, but the government is talking about 2,400. So it is a liability because in the future, the government can come back to us and tell us that we recognized 2,400 on our side, so can you bring the difference of 7,600? So in that case, this 7,600 obviously is a deferred tax liability. If you move to the next item, trade receivable, in the statement of financial position as given by that business entity, the trade receivable is 7,000, but additional information number four, the tax base is 7,500. What does it mean? The carrying amount, which is 7,000, is less than the tax base. The carrying amount is less than the tax base. Therefore, what does it mean? The government, why is it becoming an asset in this case? We recognized the 7,000 as a company, but the government recognized a higher figure. So why is it an asset? As we explained here, why it is becoming an asset. In the future, we can agree that the government recognized a higher figure by 500, 7,000 minus 7,500. So the government is recognizing a higher figure. You see, ordinarily or traditionally, carrying amount should equal to the tax base, but that is not the case here. 7,000 is not equal to 7,000. 7,000 is equal to 7,500. So in that case, the government in the future may be required to refund the extra 700 here. So that is why, in actual sense, it's like the government is having our money. So they should refund our money, the extra figure here. So that is why, in this case, this is a deferred tax asset. So I wanted to look at this solution here so that when I come to discuss about what we have done here, you will not be having challenges. So just look at it. What is there? Is I just want to move from the front because I think when I stand here, you are not able to see the board. So I just discuss the other part from the other side. So as you look at what I have done here, the solution, and I believe you have advanced financial reporting, April 2023, question 3B. So you look at it, the solution here. Remember here we have the items here, then carrying amount as they appear in the statement of financial position, tax base by the government, and then timing differences here. Remember finally, because you'll be taking the carrying amount minus tax base, you get taxable differences. Some figures will be negative, others will be positive. You add all of them. The figure that you get here, you multiply by that percent to get deferred tax charge So can you just be going through those figures to see whether you arrive at 12,800? I'll just be coming back to discuss that in a while. Just check what is happening there. I've said these are items carrying amount by the business entity given in the financial statements, tax base by the government, the timing difference or the temporary differences that is. So I mentioned some items from the back. I mentioned some items from the back. And these are the things that I want to mention from the back is just continue analyzing your question as it appears there. That assets, determination of tax base. How do we determine the tax base? How do I determine my tax base? Now, because mostly the carrying amounts will be given, but how will the government determine these figures? How will the government determine the tax basis there or the written down value? Remember, written down values is for the purpose of taxation. Carrying amount is to do with the depreciation. So here, to get the net book value or the carrying amount, we usually take cost minus accumulated depreciation. How do we get the tax base? You know that, how we get that? Cost minus what? Cost minus capital allowances. So capital allowances, but how do we really determine some of these figures here? So I want to concentrate on this part here because you know the carrying amount, how we get the carrying amount, how did the accountants calculate those carrying amounts there or the net book values. They just took cost of the asset minus accumulated depreciation. What about that? So these are the points that I want to mention to you as you continue analyzing your question there. So you can just listen as you continue analyzing that question there. That determination of tax basis. To determine an asset's tax base, there is a need to determine whether the benefits from such an asset are taxable. If they are, the tax base will be the amount deductible for tax purposes in the future period. If not, the tax base equals the carrying amount, e.g., cash at bank. So obviously I've told you, cash or just cash at bank, cash at bank or just cash in hand will not give rise to temporary differences. So, generally the tax basis will be determined as follows. 1. Depreciable fixed assets without capital allowances and which generate taxable income have tax basis equal to their carrying amount, as no cost of the asset is allowed for tax purposes, e.g., goodwill, patents, and copyrights. So what I'm saying is that goodwill, patents, and copyrights do not have what? Do not have what? Temporary differences. So if you have goodwill of 10,000, then the tax base should be 10,000. So you are saying 10,000 minus 10,000, for example. Things like patents. Okay, so most of the intangible assets will not, most of the intangible assets, the carrying amounts will be equal to the tax base. So that last column there will always be what? A 0. So what I'm saying is that if I have goodwill here, goodwill or patents or copyrights or trademarks, most of the times the carrying amount will be equal to the tax base, and therefore this column here will always be a 0 because you'll be taking carrying amount minus tax base to get a 0. So most of the times, unless otherwise stated, most of these intangible assets like goodwill, patents, copyrights, trademarks, all those ones, their carrying amount is provided for in the statement of financial position will be equal to the tax base. Therefore, this column will be a 0. So that is an important point to note concerning the intangible assets, specifically goodwill. The next point is depreciable fixed assets with a capital allowance have tax base equal to the written down value. Non-depreciable fixed assets have tax base equal to their carrying amount, since no part of their cost is allowed for tax, e.g. land. So land, most of the times, land, the tax base will be equal to the carrying amount. Depreciable and non-depreciable fixed assets and other assets which generate income not subject to tax have tax base equal to their carrying amount, e.g. cash and debtors. Assets appearing in the statement of financial position and which will be allowed as expenses in the future for tax purposes have tax base equal to their carrying amounts, e.g. inventory. Assets resulting from accrual of incomes, e.g. rent receivable, interest receivable, etc., have 0 tax base if tax is based on actual cash received. But if it is taxed on the accrual of income, the tax base equals the carrying amount. So these are some of the methods that we use to determine the tax base as far as assets are concerned. Liabilities. What about liabilities? The tax base of a liability is its carrying amount less any amount that should be deductible for tax purposes in respect of that liability in the future. Number 1, liability arising from accrual of expenses which were allowed for tax purposes have tax base equal to their carrying amount, e.g. creditors. Number 2, liabilities resulting from accruals of non-deductible expenses, e.g. fines and penalties, donations, etc., have their tax base equal to their carrying amount. Number 3, liabilities resulting from accruals of expenses which are allowed for tax purposes have a tax base of 0, e.g. leave passages. Unearned income, also known as income received in advance. The tax base of such a liability is its carrying amount less an amount of revenue that will not be taxable in the future periods, i.e. that part of liability that is taxable in the future. Therefore, if the unearned income is taxable on the accrued amount, the tax base will be 0. But if taxable on cash basis, the tax base equals to the carrying amount. So those are the methods that are used by the taxman or the government to establish the tax base. Now let's come lastly. We come lastly to this solution here, April 2023. April 2023, question number B. The solution is here. I think you have gone through it. I believe you have gone through that question. You have a question here. Right, so I think you have no question. Now you check that solution. We just go through it. You had been told that the following statement of financial position relates to ABC Limited, a public limited company, as at that 1st March 2023. And because we have read the question, I just go straight away to solution. Schedule of temporary differences. We just have a column for items, carrying amount, tax base, temporary differences. Now the first one here, you can see here, PP, property, plant, and equipment In the statement of financial position, as provided by the company, is 10,000. You look at the statement of financial position. 10,000, who can see the 10,000? You can see 10,000 from somewhere. 10,000 is there. That's the 10,000 I'm talking about. You can see 10,000. Property, plant and equipment is 10,000. The 10,000 which is here. This figure here, that is my 10,000. And then here, tax base. The tax base. You go to additional information number 4. Additional information number 4, you will see tax base there. Property, plant and equipment. You are told the tax basis of the assets and liabilities are the same as their carrying amounts in the statement of financial position as at that 1st March 2022, except for the following. Property, plant and equipment, 2,400. That one there. So you are comparing 2,400 with 10,000. So in this case, 10,000 is as per the statement of financial position, 2,400 is by the government. So 10,000 minus 2,400, you get 7,600. Now in this case, the carrying amount is more than the tax base. The first situation here, the carrying amount is more than the tax base. It's more than the tax base. It's 10,000, this is 24. That is a deferred tax liability. Why? Why is this one deferred tax liability? Because the government has provided for a lesser figure. So in the future, the government can come back to us and tell us we made a provision of 2,400. We allocated 2,400. So you have our money. So bring the difference of 7,600. So in that case, it becomes a liability. Because the government has charged a lesser figure, they can come back for the 7,600 in the future. So that is a PP. That's how I worked out my PP to get 7,600 this column. The deferred tax liability. Number 2 is trade receivables. The trade receivables, how do you get that? If you go to the statement of financial position, you will get 7,000. You get 7,000. So you may ask me, what about this goodwill? In that question, you can see goodwill there. I believe you can see goodwill. Now that goodwill, which is there, because you have taken your PPS 10,000, you may ask me, what about goodwill? If you look at information number 4, they are telling you, interesting thing there, that the tax basis of the assets and liabilities are the same as their carrying amounts. In the statement of financial position as at that 1st March 2022, except for the following. So 1, goodwill is not there. Goodwill is not there. It means that, as you have mentioned earlier, most of the times, goodwill, patent rights, copyrights, trademarks, their carrying amount is always equal to the tax base. Therefore, even if you are to put goodwill here, obviously you expect the tax base to be the same. So you take this figure minus that, it becomes a 0. Like you can see here, this figure here, for cash, you can see how I did my cash here. The cash in the statement of financial position is 6,700, and I assumed that because cash cannot give rise to temporary difference, the tax base should have been the same. If you look at your cash in the statement of financial position, obviously you find that the figure given for the cash is 6,700. That is cash and cash equivalents. You can look at cash and cash equivalents. Is it visible? Cash and cash equivalents. Cash and cash equivalents. 6,700. That is why I brought it here. I brought cash and cash equivalents here. So this 6,700 as per the statement of financial position. I assume that always cash and cash equivalents must be the same as that figure given by the government. So trade receivables, if you go to the statement of financial position, you realize that in the statement of financial position, trade receivables is 7,000. Trade receivables, you're able to see them. Trade receivables, 7,000. Trade receivables, 7,000. But it was not the same as the one given by the government. My trade receivables is 7,500 by the government. You can check there. Additional information number 4. They told you the tax basis of the assets and liabilities are the same as their carrying amount in the statement of financial position as at that 1st March 2022, except you can see for PP we have done trade receivables 7,500. So by the government, you have not seen well. Why? 7,500 is there. Trade receivables, number two item. So the figure from the government side, 75. So you get 7,000 minus 7,500, you get 500. Now this is, what is it? The carrying amount is less than, 7,000 is less than 75. Carrying amount, when it is less than, when the carrying amount is less than the tax base, then that gives rise to deferred tax asset. So this would be deferred tax asset. Why is it an asset? Because the government charged higher figure. So in the future, we can demand the government to refund the 500 back to us. So in that case, it becomes a deferred tax asset. Now, other receivables. What is the carrying amount for other receivables? If you check from your paper, other receivables, remember receivable is a data. Other receivables are given 4,600. Other receivables are given 4,600. Other receivables, other receivables under the current assets. Can you see current assets? Other receivables, 4,600. Other receivables, 4,600. But the government provided for what? The government side. The tax base by the government. Other receivables, What do you find? 5,000. Additional information number 4. Other receivables from the government side. You can see other receivables there. Other receivables, 5,000. Other receivables, 5,000. Now we can move faster now because you have understood what I'm saying. So 4,600 minus 5,000, you get negative 4,600. The next item was employee benefits. Employee benefits. What is in the statement of financial position? Employee benefits. Check that very fast. Employee benefits. Employee benefits. Employee benefits, you can get that. Now, employee benefits, it will be 4,000. It will be 4,000 plus 1,000. To be the employee benefits here. The 5,000 is because of additional information number. Is because of additional information number 3. Number 3. So employee benefits, you look at this figure here. Employee benefits, you look at the statement of financial position. Statement of financial position, you can see under non-current liabilities, you can see employee benefit liability, that 4,000 there. Is there 4,000? 4,000. And then if you look at additional information number 3, additional information number 3, what are we told? The defined benefit plan and rule change on 1st April 2021. ABC Limited estimates that of the past service cost of shillings 1 million. That's why we are earning 1 million. Past service cost. 40% relates to vested benefits and 60% relates to benefits that will vest over the next 5 years from that date. The past service costs have not been accounted for. So, the 1 million, which is past service cost. Our next chapter will be about employee benefits. So you understand what we mean by past service cost. So you can hold on for a while as we discuss. We'll discuss the employee benefits in our next chapter. So here you can see the carrying amount for employee benefits is 5,000, and then you earn the 1,000, 5,000, and then 5,200 is what has been provided for by the government. Additional information number 4. Are you able to see? Additional information number 4. Employee benefits, 5,200. Employee benefits, 5,200. That is additional information number 4. The last item there with the figures. That 5,200 there is the employee benefits, the tax base provided for by the government. So employee benefits is there. So this is, we have taken 4,000. How did you get the 4,000? 5,000. We got 4,000 as a carrying amount plus past service cost from the additional information number 3. The past service cost should be answered. We got 5,000. Then this is provided for in the additional information. So 5,000 minus this, you get 2,000, which is a positive. So remember, this is negative 5,000 minus minus. You know, minus minus becomes positive. So it's like saying minus 5,000 plus 52 to get positive 500. That's employee benefits. Financial assets. Financial assets. Do you have financial assets? The statement of financial position. Financial assets in the statement of financial position, they are given at how much? You can just check financial assets. Financial assets have been given at cost. Financial assets have been given at cost. Financial assets, you can see financial assets, the last item there. Financial assets at cost, 9,000. But if it is a figure, if an asset has been given at cost, then we should use the net book value. We can use cost. We are interested with net book value or carrying amount. And carrying amount means cost minus accumulated depreciation. So what we should use for that particular item, for financial asset, we should use additional information number 1. We use the market value. We use the market value or the fair value. So you read additional information number 1. What are we told? The financial assets are classified as fair value through other comprehensive income as is shown in the above statement of financial position at their cost on 1st April 2021, including transaction cost of shilling 0.5 million. The market value, that is the answer now. The market value of the assets is 10.5 million on that 1st March 2022. Taxation is payable on the sale of the asset. So we used 10,500,000. That's the carrying amount. Additional information number 1. And then tax base, it should be based on cost. The cost now, which is in the statement of financial position. So 10,500 minus 9,000, you get 1,500. Borrowing costs. Look at borrowing costs. Borrowing cost, what is in the statement of financial position? Confirm that. Go to the statement of financial position and you get the borrowing cost. It's called long-term borrowing. Long-term borrowing. Long-term borrowings. It has been given at 10,000. It has been given at 10,000. The borrowing cost from the statement of financial position, should be able to see it there. Borrowing cost. Long-term is called long-term borrowings. Look at non-current assets. Long-term borrowings, 10,000. 10,000. 10,000. Long-term borrowings, 10,000. 10,000. And then you look at additional information number 2. Additional information number 2. What are we told? The stated interest rate for the long-term borrowing is 8%. The loan of shillings 10 million represents a convertible bond which has a liability component of shillings 9.6 million and an equity component of shillings 0.4 million. The bond was issued on that 1st March 2022. So my carrying amount becomes 9.6. That's my carrying amount from that additional information. And then you less 10,000, you get 4,000. Intangible assets. Intangible assets from the statement of financial position. Intangible assets. You are told other intangible assets. The figures have been provided there. Other intangible assets is item number 3 from the top. Other intangible assets. Other intangible assets, 5,000. 5,000. And what is the tax base? Other intangible assets. If you look at additional information number 4, the second bullet there, you are told other second bullet from the top after employee benefits. Other intangible assets are development costs, which were allowed for tax purposes when the costs were incurred in 2021. That's the point. That is, other intangible assets are development costs, which were allowed for tax purposes. So they are allowed. So if they are allowed for tax purposes, then the tax base here should be 0. They are allowable. So 5,000 minus 0, 5,000. That is intangible assets. Trade payables. A payable is a liability, so your figure here should be a minus. Trade payables. Can you read it from your table? From your question. Trade payables. Can you see it? Trade payables is trade and other payables. I can see 5,000, which should be a negative. 5,000, which is a negative. Almost towards the end of that, trade and other payable. You look at current tax liabilities. Current tax liabilities. Can you see current towards the end of the page? Towards the end of the page, current tax liabilities. You have current tax and then you have trade and other payables. Trade and other payables, 5,000. Trade and other payables, 5,000 is a negative figure. Is a negative figure. A liability you should put a negative for the liabilities. Assets have a positive figure. Now those payables ought to be the tax base about payables. Additional information number 4, the last bullet. Additional information number 4, the last bullet there. What is in the last bullet? Additional information number 4. Trade and other payables include an accrual for compensation to be paid to employees. These amounts to shillings 1 million and is allowed for tax purposes when paid. So it is allowed. Now if it is allowed, then it means the 5,000 minus 1,000, which gives you 5,000. In other words, they are just telling you this 1,000 is the taxable difference, the 1,000. In other words, you can just put the 4,000. You can say 5,000 minus 1,000 is 4,000. 5,000 minus that, you get that negative figure. So in other words, they are telling you that temporary difference is the 1,000. That's the trade payables. Cash, I told you that cash and bank balances, the carrying amount is equal to the tax base. So this minus that is a zero. So once you have done that, basically, once you have all the carrying amounts for as given by the accountant in the statement of financial position, then all the tax bases you get temporary differences, sum up all these columns to get what? Net taxable timing differences. You add all of them. You get taxable, net taxable timing differences. If you add all these, you are getting 12,800. Then deferred tax charge, that percent of this, 30% of that, you get the deferred tax charge. So that percent of 12,800 gives us that 840. That 840. So that is basically how we could have attempted that question. And I think we had been told required was by applying the requirements of IAS 12 income taxes, calculate the temporary differences after the necessary adjustments. That one you had been given 10 marks. So 10 marks you are to show these temporary differences after the necessary what? Adjustments. So here you could have scored the 10 marks there. And then number 2, determine the deferred tax charge for the year entered at 1st March 2022. So the deferred tax charge, if you score these 8 marks there, the deferred tax charge you can just get 30% of that, because you are told number 6, additional number 6, additional information number 6. Assume taxation is payable at the rate of 30%. So to calculate deferred tax charge, you just take that percent of that figure. Now, I think that is what we were supposed to do as far as that question is concerned. So I think we should come to the end of our discussion. So I think it has taken us how many hours or how many minutes? Is 1 hour and 32 minutes. So it's around 1 hour. That means. So is that means extra, because we usually take that class 1 hour or sometimes 2 hours. So it's not we have tried to save time, because what we have done, what we have tried to do is to do theory part of IAS 12 and also attempt a question from the past papers, which is a good thing, because you still have our books. We still have advanced financial reporting textbooks. So I think we are doing very well as far as our discussion is concerned. So understand the theory part of it. What are temporary differences? What are timing differences? What is our current tax? What is our deferred tax? And then carrying amounts, tax bases, and then how to calculate all those figures. So this is the Fatima Institute Center for Civil Studies. My numbers will be here. I'll give you my number here. And this is plus 254 727 87 10 93. This number is 3. The last number is these were following from foreign countries or out of the country. You start with plus 254. We are looking for assistance or any help as far as our classes are concerned. Plus 254. That's the code for Kenya. Plus 254 727 87 10 93. We are just within the country. 0727 87 10 93. So you can like our video. You can like our video. You can make a comment. You can also subscribe if you are waiting for an examination, so that whenever we make a class or a video, you are notified, and then you are able you are able to be updated concerning whatever we are doing on this side. So next time we'll have one more class concerning IAS 12. We'll take one more example and then we will move to the next topic. So we can meet again because we have more time. I think the examination is 2 months away, but I think we should move a little bit faster so that we can start our revision classes as early as possible.